Hello and welcome everyone to Secure Your Legacy, Planning Essentials for 2021. My name is Daniela and I'm the Associate Director of Legacy Gifts here at the PETA Foundation, where I've worked for over 12 years helping members like you. We're excited to be here with you today to learn important information on how we all can make a financial and estate plan that will meet our personal and charitable goals. I'd like to point out that if you have any technical difficulties, please use the Q&A box at the bottom of your screen and a PETA staffer will help you right away. If you have any questions during the webinar, please type those into the Q&A box as well. We will be answering as many as possible at the end, and if we don't get to yours, we will follow up with you after the event. My co-host today is Sepde Daneshman, Senior Philanthropic Specialist, who has been with the PETA Foundation for more than 7 years and is my colleague in our Legacy Gifts Department. Our featured presenters are Joshua Levine and Bill Ringham from RBC Wealth Management, who will describe important strategies for planning our personal finances in 2021. And we have with us Florida attorney Peggy Hoyt, who will speak about creating an estate plan that ensures care for ourselves and our loved ones. But to start us off, I am happy to turn the virtual mic over to PETA President and Founder, Ingrid Newkirk. Ingrid?
Thank you, Daniela. To all of you who are joining us, I really look forward to the time when we'll be able to meet again in person, because I know if you're with us today, it means that you're a kindred spirit. So getting together in the future is going to be really lovely. You belong with us and you share our desire to help stamp out speciesism. Your membership is quite special to us, as I hope you know, and it's what makes it possible for PETA to always be in the animal's corner. Our focus and our determination has never wavered since our first undercover investigation, when we brought to light the torture inflicted on this monkey, Augustus. Many of you are members of PETA's Augustus Club, and I remember him well. I used to brush him and feed him because we got Augustus and all the other monkeys out of that lab. And that allowed us to wake people up for the very first time to the abject cruelty, the waste, and the fraud of animal experiments. That Silver Spring monkeys case established huge precedents, including the first confiscation of monkeys from a laboratory, the first conviction of a vivisector on charges of animal abuse, and the first cancellation of federal research funds for cruelty, and the first US Supreme Court victory for animals used in experiments. That lab shut down, and the man who tortured those monkeys never, ever experimented on animals again. Augustus continues to be our guiding light, and we honor PETA supporters who are making legacy gifts to us with their special status as members of our Augustus Club. Now, 41 years after rescuing him, we've knocked out hundreds of blocks from the Jenga tower of vivisection, and we get closer every single day to toppling it over for good. This is all thanks to you. You've helped us persuade the EPA to spare hundreds and hundreds and hundreds of rats and rabbits and guinea pigs every single year from having pesticides smeared into their eyes, into their shaved skin. With your annual gifts, your monthly support, you have helped us convince the second largest school district in California to launch a pilot program to replace dissection on real animals with dissection software donated by PETA. You helped us bring about a new rule in China that allows imported cosmetics to be sold without being tested on animals, something required until PETA pushed, and this is all within the past 6 months. You have also helped us lock up animal abusers. We work with the police to arrest people who post videos of themselves punching and otherwise torturing animals on social media. And sometimes we get their animal victims rescued and adopted, like Oreo here. We found a home for him after we got a young man arrested for beating him and for posting a video of it on Snapchat. That young man is not allowed to own animals anymore. Whether it's persuading Calvin Klein and Tommy Hilfiger to not only stop selling fur, but to stop selling all exotic skins, or it's shutting down almost every single abusive exhibitor featured in the Tiger King docuseries, which we've done, we're racking up new victories for animals every day. However, honestly, it's the work you've done that allows us to succeed. Whether you're a teacher or a computer programmer, or you've retired, when you make your donations each month or each year, when you leave a legacy gift to PETA, every minute you've spent earning and saving and investing that money translates directly into ending an animal's suffering, into helping the fashion industry develop new cruelty-free materials, passing an animal protection law, changing a consumer's mind, even closing down a laboratory or a roadside zoo, and many other wonderful things. I just wanted to pop in and thank you for taking such powerful action for the animals that we all cherish. We are honored to work for your goals, our mutual goals. Thank you so much. Now back to you, Daniela.
Thank you, Ingrid. Before I introduce our first presenters, I want to note that the presentation today is general information and is not meant to take the place of financial and/or legal advice. We always encourage our members to consult with their own financial and legal advisors who know their personal situations. And so with that said, I'm delighted to introduce our first experts. Joshua Levine is a Senior Vice President and Financial Advisor with RBC Wealth Management. He focuses on increasing the long-term permanent capital of nonprofit organizations and private clients, with a unique focus on animal welfare, environmental, and socially conscious, including cruelty-free investments. Josh has been a friend and advisor to PETA for a long time. Joining him is Bill Ringham, his colleague at RBC, where he is a vice president and director in private wealth strategies and specializes in wealth transfer, including trust and estate planning, charitable planning, and stock option planning. Josh and Bill, over to you.
Thank you so much for the introduction, and it's a pleasure to be with everyone today. While, as Ingrid said, we'd love to be with you in person, it's an honor to join this information session with you today via webinar. So as was mentioned, I'm a lifelong animal welfare activist and a financial advisor specializing in cruelty-free investing. And I'm fortunate to be the financial advisor to PETA and many of the other animal welfare organizations and the donors that support them. And so let's jump into it. If you turn to the agenda slide here, I'll be talking obviously about ESG and cruelty-free investing, which is my specialization at RBC. And then I'll be kicking things off to my colleague, Bill Ringham, who'll be talking about general estate planning strategies. And then the third portion will be passing on to Peggy, who'll be discussing animal companion strategies. So next slide, please. Let's jump into it. 2020 obviously was a year to forget. It was a very, very difficult year for everyone. It was a year filled with so many risks and uncertainties. For example, with the pandemic, how many people would be affected with the pandemic? How many people would pass away, and would our hospital systems be inundated? If we were forced to shelter in place, how would people find income, and how would they keep their job and continue to earn a living? Would small businesses like hair salons and restaurants stay in business? Would large businesses stay afloat? Fortunately, however, the governments from around the world came together with such velocity, not seen even in the 2008 pandemic, to put forth a number of stimulus measures to meet those risks and mitigations. For example, they passed the PPP loan program, they passed the CARES Act, and they put forth a number of unemployment stimulus measures, which are still ongoing today. Federal Reserves from around the world did their part by lowering interest rates to zero, making it easier for people to take out loans. And they also provided a very important backstops to large corporations to have them stay solvent to avoid a financial crisis like we saw in 2008. So it's no surprise then, in the midst of all this uncertainty and the crazy year that we've had and are still undergoing, that one of the most important risk reduction strategies that investors can take really came to the forefront and really hit an inflection point this past year. I'm speaking of environmental, social, and governance investing, or ESG investing. ESG investing had its roots, decades ago, honestly, where it was initially called ethical investing, where the concept was, to mirror your investments with the ethics and or the goals of a nonprofit, for example. And while that's a very important mission, we saw that evolve certainly over the decades through the civil rights movement or through the Vietnam War. Obviously, fast forward a couple of decades later, and it was a very integral component to overturning apartheid in South Africa. People no longer wanted to invest in companies that partake or participated in the South African economy, causing companies to pull back and causing the economic engine to collapse, if you will. It then evolved even further into climate change. And we see it now evolving, as I'll get into in a moment, into other categories, such as diversity, inclusion, and cruelty-free investing. So let me dive into explaining the E, S, and G components a little bit further. So E represents the environmental concerns. It represents climate change policies. Is a company on the forefront, for example, for future climate change initiatives? Are they using their resources wisely? Are they reducing, reusing, recycling? Are they using their inputs and outputs to reduce pollution, both air and water? From a social perspective, are they treating their employees well? Are their stakeholders and customers being treated well? Are they attuned to current issues such as the Me Too and the Black Lives Matter movement, where consumers are integral in how companies interact and where products are manufactured? And from a governance perspective, do they have proper accounting policies? Is the pay equitable? Is their board comprised of people from all races, backgrounds, and genders? And these are the important issues, obviously, that help lower the risk of certain investments. And just don't take my word for it or PETA's word for it. We've now gone through decades where we've had very detailed peer-reviewed research come out from the likes of Mercer and Harvard and Yale that talk about how when an investor undergoes and places ESG screens on their investments, you actually, again, reduce the risk, thereby increasing the return, providing better return. So as they say, by participating and doing ESG investing, you can have your vegan cake and eat it too. Next slide. So, as I mentioned, the evolution of ESG investing, we're now seeing a new age where it's now getting into what we could call cruelty-free or animal welfare investing. So in other words, those three components, the E, S, and G, are integral from a cruelty-free perspective. So let's take E, environment. Well, we know that animal agriculture represents 14% of greenhouse gas emissions, more than the entire transportation sector. We also know that the USG estimates that the production of a quarter-pound hamburger produces 460 gallons of water just for one hamburger. Obviously, growing vegetables is a fraction of that. So the usage of our resources and the emittance of carbon and other greenhouse gases is very troublesome when it comes to the animal agriculture space. From a societal perspective, the S, while the origins of COVID still have yet to be determined, we know that the swine flu, the bird flu, H1N1, originated in wet animal markets. And we can see the importance of avoiding and hopefully eventually phasing these animal markets out and identifying the risks that companies who are involved in those may place as further pandemics may unfold in the future. A couple of years ago, the World Health Organization also defined processed meats as a type 1 carcinogen, like tobacco. And we see over the years and decades how tobacco and vaping and many others are coming under regulatory scrutiny, and how sugary drinks are being taxed. So the question for food producers is meat far behind in that tax regime? Then from a governance perspective, we know that many in the animal agriculture, clothing, and vivisection space have made poor corporate decisions. So FAIR, which stands for the Farm Animal Investment Risk and Return Initiative, recently estimated that 60% of companies aren't managing risks or don't disclose proper information. 77% of companies are deemed high risk when measuring antibiotic and overuse of antibiotics. And 75% of land-based companies don't disclose waste management practices. So we can see from a governance perspective that many of these companies and then their investors are essentially setting up a ticking time bomb that could present unprecedented risks for those investing in those companies. Next slide. And this is a graphic of what I was mentioning before. And so hopefully we've tempted your palate just a little bit of the importance, not just from an ethical perspective, but from a return perspective, to participate in cruelty-free investing. And the next question may be, well, that's great. And next slide. But how do I actually participate? What mechanisms are in place for me to move forward and actually start screening my investments to be in line with my ethics and reducing risk? Well, there's a few options. If you're a do-it-yourselfer, there's great resources out there, such as cruelty-freeinvesting.org, which allows you to, or provides, I should say, resources and tools to help you do your own self-selection. It also provides a list of financial advisors who can help you screen your investments. We were fortunate enough to have a whole host of ESG investments out there, including the very first vegan ETF and many other animal agnostic, industry-specific investments that people can partake in. Then there's the opportunity of what I call shareholder advocacy. So when you own shares of a company, a public company, you have the opportunity to attend the annual meetings and speak with other stakeholders, speak with the corporate governance, the C-suite, if you will. And this is something that I spend a lot of my time helping PETA engage in. PETA has been very successful over the years attending numerous annual meetings. They've persuaded biotech and pharmaceutical companies, for example, to reduce animal testing and introduce non-animal methods. They've also worked with clothing manufacturers and others to reduce animal products as part of their processes. And it's not just working against challenging companies and making them better, but they also work against thematically positive companies like Tesla. And they were instrumental in pushing Tesla to make a leather-free alternative to their vehicles. Then there's also the opportunity of private equity. So if you're an accredited investor, certainly you can get in on the ground floor and invest in the plant-based companies of tomorrow, the Beyond Meats of tomorrow, for example. Many companies are now becoming public. Beyond has been public for a couple of years now. Oatly is on the market to become public this week. Just is scheduled to become public later. But many want to invest at the ground floor. And again, if you're an accredited investor, fortunately, there's a number of vegan alternatives that are out there in the private equity space that may find of interest. So again, hopefully we've enticed you to, not only invest with your feet and partake in advocacy, but also invest with your dollars and pay close attention to how your money is working for you. And so with that, I want to pass it on to my colleague, Bill Ringham, who will be discussing timely and general estate planning strategies. Bill?
Great, thanks, Josh. Good afternoon, everyone. Thank you so much for having me back again. And thanks to PETA, as well as everyone out there listening. As we started talking about a little bit of whether you're giving monthly or you're giving a legacy gift, understanding just gifting opportunities in general, as well as tax effective gifting is really helpful. And so for this next little section, we're really going to narrow down the gifting concept to charitable opportunities. So I'm not going to get completely geeky, but I will kind of get into the weeds on a couple of things that I think would be really helpful to know and understand. We're going to be focusing on outright gifting of charitable, your charitable gifts, as well as how to incorporate charitable gifting in your legacy plans. Outright gifting, of course, you have to worry about, whether or not you have adjustable gross income that you want to, utilize, because you're limited on your gifts during your lifetime. Where at passing, you can give your entire estate to charity if you want, and there's no limit to at that point other than how much you own. So we'll look a little bit into the benefits of cash versus stock and even other property, and then talk a little bit about how you can structure some planning opportunities in your estate as well. So on the next slide, let's look at just some of the more diverse ways to gift. By far and away, most people gift by cash or check. We whip out our checkbook, or I'm old, I still write by check, but whether it's Venmo or however you transfer money to your favorite charity by cash or that. I'm going to give you a specific example of why it makes sense, if you have appreciated securities, to give those from a tax saving perspective, as well as I'll talk a little bit more on the qualified charitable distributions, how those work and how they can be really effective for those taxpayers that are over 70 and a half. A couple of things that I do see here on designation of charity as a beneficiary. I think this is sometimes overlooked. And there's three examples here. An insurance policy, for instance. If somebody has an insurance policy that they no longer need for protection, they decide they want to keep that policy. Sometimes what I see people do is actually list a charity as the beneficiary of that insurance policy. So at their passing, the insurance policy goes to the charity, maybe instead of to their other intended beneficiaries. Transfer on death is just another way to leave by a beneficiary designation, or payable on death in a bank account perspective. But what I'm also seeing more and more on is, instead of people maybe leaving that legacy in their will or their trust, which is still fairly common, looking at doing it via a beneficiary designation on their IRA or their 401k. And the reason why this could be so powerful is that if I were going to make a contribution to PETA and I decide to make it out of my estate, they might take my assets and give it to PETA. Alternatively, if I decide to give part of my IRA to PETA, I could either make them part of a beneficiary of my IRA. So at my passing, my IRA dollars go directly to PETA. The neat thing about that is that PETA, as a charitable organization, does not have to recognize ordinary income on the receipt of those dollars. If I left those dollars to my children and they were to inherit those and take distributions out of that, they would have to pay ordinary income. And so it's one of those things where you're looking at tax effective gifting based upon what types of sometimes assets that you have. Donor advised funds is another phenomenal opportunity for individuals. It allows you to put a pool of assets that are outside of your estate into a donor advised fund. It's much like a private foundation, but there tend to be lesser amounts. They're typically administered by a nonprofit organization. And then you can direct gifts out of those later on. So sometimes we have people that have significant liquidity events, a large sale of a business, or they've done really, really well in the ESG investments, and they sell them and now they have a big gain and they want to accelerate some of the deductions, but they don't know who to gift to yet. So they'll put money in a donor advised fund, they'll get a deduction now, and then use that donor advised fund to make contributions to charities next year, the year after, or the year after that. I did mention the outright bequest via a revocable trust or will. Do see that a lot still, where people, and you're going to hear from Peggy on this one, so I'm not going to steal all Peggy's thunder, but just a little bit of, that specific bequest. I want to give PETA 10% of my estate. The rest of my estate goes to my intended beneficiaries. And then much more complex planning opportunities, but personal residences or qualified charitable remainder trust or charitable lead trusts. And so, working with your financial advisor, your attorney, your CPA, and your team of advisors, structuring it from simple, I'm going to leave money, to I'm going to create a private foundation, gives a plethora of options that are available for charitable giving. If we move to the next slide, a couple of things that I wanted to point out quickly. The first is the CARES Act, and more recently under the Coronavirus Response and Relief Act of 2021, it made and extended a couple things that I think are really important. First of all, there's this $300 above line donation. You don't have to itemize. If you take the standard deduction, you can still make this contribution above the line. And for some people, that's like, well, it's not a lot of money, but for other people, it is an exceptional amount. And what I've seen people do is give $300 to their children and say, well, who would you give this to? And so if your children are really interested in giving to PETA, you might say, you take a standard deduction, but I'm going to give you 300. Now you can give it to PETA. And it's $600 for a married couple. Another significant thing that the CARES Act and then the following act did is increase contributions of cash to qualified charities up to 100% of your AGI. So if you're 100% of your AGI, if your AGI is $100,000, you could give up to $100,000 to charitable organizations as long as it's cash and offset all of your income. That's increased from 60% and it just lasts through 2021. I'm going to go to the next slide because there's a couple of other things here. If in fact you do exceed how much you give this year, so let's just say you exceeded your limitation that you can give during your lifetime on an annual basis, you get to carry forward that excess contribution for the next 5 years to absorb in. And then something else I wanted to we could almost have a whole hour on this one, but if you're thinking of making significant gifts, you know that your charitable contribution will be fairly large. And so sometimes instead of letting income drive charity, it's charity driving income, where it gives you an opportunity to look at income recognition events. And so we've talked to people that are making significant charitable gifts and they want to increase their AGI. And so looking at things like a Roth conversion, where you're taking a regular IRA and converting it to a Roth IRA, that's an income event, but it allows you to then offset maybe some of your charitable contributions. And then I just have two more thoughts, and then I'll turn it back to PETA. But on the next slide, I wanted to go over a little bit about why it's more powerful to give appreciated assets such as stock to charity versus maybe just writing that check or giving cash. And so I wanted to use this example. Let's say you have $200,000 of adjustable gross income, which puts you in the marginal tax rate of roughly 24% under the current tax environment. Let's say that you also have a stock that is now worth $30,000, but you bought it for $5,000. So if you were to sell that stock, you'd have $25,000 of gain, of which you would have to pay capital gains. So if you look at this, instead of selling that stock, you could transfer that stock to the charitable organization and avoid the capital gains as long as you've held that appreciated asset for longer than a year. And under this, if you're in the 15% capital gains bracket, you've saved $3,750. So instead of recognizing gain and netting less the tax that you owe, the charitable organization gets the whole $30,000. And if, in fact, you're giving appreciated property, you come up to certain AGI thresholds. In this example, we're way below the 30% threshold, so that would be $60,000. So now you can actually take then the charitable deduction, as long as you're able to itemize, of another $7,200. So all in, you're at $10,950, which is a fairly significant tax savings by actually transferring that appreciated asset to charity versus just writing a check after you've already sold that particular asset. Sometimes I hear this, I love that stock, though I don't want to sell that stock. Well, gift that stock and then buy it back into your portfolio with now a basis equal to the amount of $30,000. And then the last one that I want to really focus on here are what we call qualified charitable distributions from an IRA. And individuals that are over 70 and a half can actually make a contribution to charity directly from their IRA up to $100,000. If you're 72 or older, this even qualifies as part of what we call your required minimum distribution. And this is incredibly powerful for a couple of different reasons. Sometimes people don't need to take all of their distribution that they receive every year. And so they're going to redirect part of their IRA to charity instead. But when you think about it from a different perspective, and this will be on, I believe, the next slide, it's really kind of one of these things that it's beneficial for a number of different ways. It's one of those things where if in fact you make this contribution, you're decreasing your adjusted gross income, which factors into other things. Because you've given, let's say, $10,000 directly from your IRA to charity and not recognize it as taxable income, your adjusted gross income goes down, which affects things like how much of your Social Security is subject to taxability, how much of medical premiums cost, as well as the exposure to the 3.8% and the 0.9% healthcare surcharges. And so if in fact you have significant IRAs or you're looking at making contributions from your IRA directly to charity and you are over 70.5, you should really be contacting your financial advisor and talking this with your tax advisor as well. So that is part of the technical component that I was wanting to give to you. I apologize if I got a little too into the weeds, but just really kind of fun ways to benefit PETA and the organization. With that, I'm going to give it back to you, PETA.
Thank you, Josh and Bill, for giving us those fundamentals of cruelty-free investing and the opportunities for us in 2021. Now, we switch gears a bit to focus on the planning we need to have in place today to ensure that those who depend on us, including ourselves, are taken care of in the future in case we suffer a medical emergency or illness as we age or after our lifetime. To guide us, we are pleased to have with us Peggy Hoyt, who specializes in estate planning, elder law, and animal companion planning. She has been featured on CNN Financial News, in the Wall Street Journal, and in the Orlando Sentinel for her dedication to animal companion planning. Peggy, the virtual floor is yours.
Thank you so much. I really appreciate the opportunity. I think maybe I did not do that correctly. Are you seeing my screen properly? Excellent. Well, thank you very much for having me again today. And thank you to both Josh and to Bill for talking about two of my favorite subjects, cruelty-free investing and philanthropic giving. And then this is my absolute favorite topic, which is talking about how do we protect our animal companions as part of our estate plans when we're talking about how to protect ourselves, our families, and those that we love. So I always like to start out by saying it's just like the airlines remind us. You have to put your own mask on first. You can't help other people and you can't help your animal companions until you help yourself first. So I wanted to talk just briefly about creating a personal estate plan for yourself. And I think one of the most overlooked areas when we're doing estate planning is disability. What happens if you become mentally incapacitated during your lifetime? And this has come up a couple of times in my practice just this week, where I talked to families where they had a loved one who is now suffering from a memory disorder, and yet they've waited too long. They've waited to the point where the person is now not legally competent and can't enter into any type of proper estate planning. So what I would encourage people to do is review your planning, make sure it's current with state law, because state laws are constantly changing. And as part of your disability plan, you're going to want to make sure that you have a durable power of attorney for financial decision making. And these are really important as we age. Number one, for the incapacity issue, but number two, because if we have to rely on others to help us do planning, such as long-term care asset protection planning, or taking care of our animal companions, we want to make sure that we have the proper provisions in those powers of attorney. So you're probably not going to want to have a power of attorney that's a one-page document that says something like, you can do anything I can do. You'll want to have one that's very specific, very comprehensive, and that addresses all of the potential issues that could come up in the event of mental disability. And you're going to want to choose people that you trust, because this is the equivalent of taking out your checkbook, signing every check in the pack, and then handing it over to somebody. So you want to make sure that the individuals that you choose, either friends or family or other trusted individuals, that they are the people that will have your best interests at heart. Secondarily, in addition to taking care of financial decision-making, you'll want to have a durable power of attorney for healthcare, sometimes called a healthcare surrogate. And these are the people that you would nominate to make healthcare decisions for you if you're unable to make those healthcare decisions for yourself. Extremely important. In Florida in particular, we have a choice. We can make that power of attorney effective immediately, so your loved one can contact your insurance companies or talk with your doctors, or they can be effective only in the event of your mental incapacity. That's a counseling question that you should talk to your legal representative about. In addition to having your healthcare power of attorney for everyday medical care type decisions, you'll want to think about whether you want a living will. Now, your living will is not a trust and it's not a will. It is your expression of how you want to be cared for at the end of your lifetime. And so typically it's a multi-pronged approach. The first approach is, are you capable of making your own decision? The second is, do you have one of three illnesses? Do you have a terminal illness, an end stage condition, or are you in a persistent vegetative state? And then the third prong of this decision is, has the medical community determined that there is no hope of your recovery? And if the answer is yes to all three of those prongs, then your living will says, do not keep me alive using artificial means, do keep me comfortable and alleviate my pain. And the people that you're nominating here are people, again, that you trust, that are going to make these, carry out these directions. They're not making your decision, they're carrying out your direction, and that they're going to do this with your best interests at heart. I think it's also important to point out here that a living will is not the same as a do not resuscitate order. And I think people get those confused on a pretty regular basis. So just make sure you understand the difference between those. You can only get a do not resuscitate from your doctor. You can't get that at the lawyer's office. And then the last instrument that we see in the disability planning arena is what's called a pre-need guardian declaration. Pre-need because you don't need a guardian today, and with proper planning, hopefully you'll never need a guardian, but a pre-need guardian declaration is your nomination in advance of those persons that you would have make your legal or financial or healthcare related decisions for you if you found yourself in the guardianship court. So you can see that planning for disability is really, really important and something that you don't want to wait too long for. The other aspect of planning has to do with planning for what happens when we die. And typically people think of, I need a last will and testament. That's the instrument that's going to talk about how my assets are going to be distributed at the end of my lifetime. And that's true to a point, but your will only controls those assets that you own in your individual name. So if you own an asset jointly with somebody else, or you've named a beneficiary on an asset like a life insurance policy, or a pay on death on an investment account, or a beneficiary designation on your retirement account, that is not going to be governed by your last will and testament. So last will and testament only controls things in your individual name, and last wills require probate. And I think a lot of people think that last wills avoid probate, but they actually require probate. And that's one of the reasons that living trust became so important, is that people learned the mantra, avoid probate, save taxes, get a living trust. Living trusts are very important parts of lots of people's plans, but whether you should have a will or whether you should have a trust is not going to be dependent upon how much money you have, but instead, what are your estate planning goals and how is the best way to accomplish them? So a living trust is an instrument that's created during your lifetime. It has provisions for you while you are alive and well. It also includes instructions for how to take care of you if you become mentally disabled, and it can include instructions to provide for your spouse, your children, and your animal companions in the event of your disability. And then the last thing it does is that it talks about how assets should be distributed at the time of your death. And sometimes assets are distributed outright to beneficiaries. Other times they're distributed in what we call continuing trusts. This could be a continuing trust for the benefit of a spouse, for the benefit of a child, or my favorite topic, for the benefit of your companion animals, for the animals that you love, your dogs, your cats, your horses, your rabbits, your chinchillas, your birds, all of those animals that make up our children who wear fur coats. So when you have a trust, you still have a will, only now it's called a pour over will, because its job is to capture assets that might be held in your individual name and then put them into your trust so that your trust can describe where those assets should be distributed after your death. So some of the things that we talk about when we're counseling with clients is protection for your family. So if we're talking about protection for a spouse, we might be talking about what we call remarriage protection, or sometimes I refer to this as Biff and Bambi protection, making sure that if we leave assets for the benefit of a surviving spouse, that they don't accidentally pass to the next spouse in line. So if our spouse were to remarry, or if we're trying to protect our spouse from changed circumstances. Trusts are popular when we have blended family situations where we might have your kids, my kids, and our kids. We might be talking about catastrophic creditor events and how trusts can protect us in that incidence. And very typical would be nursing home care. How do we protect family assets if we have a loved one that may require long-term care and we don't have the resources to pay for that long-term care? The same would be true if we were in an unmarried relationship or if we had a life partner. We may want to create a trust for the purpose of protecting our life partner, but also being able to control what happens to those assets at the end of that person's lifetime. And of course, the same benefits for asset protection that would be available for a spouse could also be available for a life partner. Often we want to protect our children or our grandchildren, and lots of reasons why we need to create trusts for their benefit, because of their age or their immaturity, sometimes like what I like to call the age of maturity. So we talk about something that I know Bill and Josh are familiar with is a phenomenon we call affluenza. What happens if people inherit too much money too fast? How do we deal with that? Maybe we have beneficiaries that have financial inexperience and need to be protected. We might have beneficiaries that have drug, alcohol, gambling, or other dependency disorders. We may want to protect our children or our grandchildren in the event they become divorced in the future to make sure that family assets stay in the family. And then lastly, catastrophic creditors for our loved ones as well, our children and our grandchildren. And then no planning would be complete without talking about planning for our animal companions. I don't know if I'm the only attorney in the whole world that does this, but my intake form asks about your pets just the same way that it asks about your children. It says, what animals do you share your home with? And then we talk about what are the plans for what would happen to them if something happened to you. The good news is that today, trusts for animal companions are now valid in all 50 states and the District of Columbia. This means that we have no impediments to making sure that our animal companions are taken care of with a trust for their benefit. In addition to trusts, and I'm going to talk more about that in a second, we could also include as part of our animal companion plan what I refer to as a veterinary power of attorney. This is a nomination of someone that you trust to make veterinary decisions for your animal companions if you're unavailable or unable to make those decisions for yourself. I also encourage people to fill out what I call babysitter instructions. These are the instructions that you might leave for a sitter or somebody that was going to come into your home to provide care for your animals in the event you were going on an extended vacation. But this is everything that somebody would need to know about your animals to provide them with proper lifetime care. Things like what do they eat? What's their health requirements? What kind of medications do they take? What are their eccentricities? The things that only you know that you would need to pass on to somebody in terms of instructions for both the short-term care of your animals and the long-term care of your animals. The other thing I like to encourage people to do is carry emergency alerts, either in the form of a wallet card that lets someone know that you have animals at home that might be alone if something happens to you. You can also make a sticker, put it in your car on the dashboard. In the event you were to have some sort of an accident, it would be immediately visible. I have a tag that I hang on my briefcase as well that says, I have animals that are home alone. You could also have decals on the outside of your home or your office if you routinely have animals there that lets first responders or others know that there might be an animal there that needs to be rescued. I always remember a story where an animal was not identified and there was a home fire, and there ended up being a disaster because nobody knew that the animal was confined in the home. So these are just a couple of ideas, things that you can think about from a planning perspective. So when we're talking about the types of trust that might be available for animal companions, there's a variety. First, there's the community trust for pets. This might be a trust that you join. It's one that's created by an organization for the benefit of multiple animals. So you don't have to create your own trust. You can join a community trust and provide for the lifetime care of your animal. And usually these are created by charitable organizations. You might also consider what would be called a testamentary or a standby pet trust. This would be the type of trust that would be created as part of another legal document. So you could have a standby trust as part of a last will and testament. And this is not something that I necessarily recommend because of the delays that are associated with probate. You would not want your animals to have to wait for care or have your selected individuals have a delay in having access to resources for the care of your animals. And if a person had to go through the probate process, that could result in a significant delay. So I prefer to see pet trusts or trusts for the benefit of animal companions in a living trust. And so a living trust can create these continuing trusts, as I mentioned earlier. And one of those continuing trusts could be a trust for the benefit of your animal companions. That's what I have as part of my plan. If something happens to me, there's a trust that's going to be created for the benefit of all of my animals, my 3 horses, my 6 dogs, my 2 cats, so that they can actually stay in their own home, my home, and nothing changes in their life. Essentially, I'm not there, but a pet caregiver, an animal companion caregiver, moves in to provide them with lifetime love and care. And then I've left the resources for their benefit to make sure that they will have all of the money that they need to provide for the mortgage, the utilities, their food, their veterinary care, compensation of the pet caregiver, and all of the expenses that you could possibly think of. So that type of trust can be created either as a standby trust or our next category, which is the standalone trust. And this is a trust that would be custom drafted for the primary purpose of providing lifetime care for your animal companions. So very common to do standalone, single purpose type trusts for animal companion care. These would be custom drafted, and as a result, you should work with somebody who's well-versed in how to create these types of trusts for the benefit of animals. I definitely recommend when you're seeking professional advice that you get people that have experience in this area. You wouldn't want to do investing on your own. You would want to call Bill. You would want to call Josh. Same thing with legal advice. This is not a do-it-yourself project. There's way too much at stake here, including the lifetime care of your animal companions. So we definitely don't want to leave that to chance, and we want to make sure that they are well taken care of. So some of the lifetime care options that you can think about for animal companions are who's going to be the caregiver, who's going to be the trustee, and what are the resources that you're going to leave for those animals' benefit. How much do you need to leave? And I know we're going to talk about that more. If your animal companion is going to be rehomed, what do you want that to look like? Are they going to go to known caregivers, people that you already know and trust? Or is this going to be somebody that's going to be selected by your trustee? So if they're going to be selected by your trustee, your choice of trustee is going to be very, very important. And then last but not least, some animals are best cared for in an animal sanctuary or a community type environment. Animals like birds or horses or animals that might be hard to rehome may not be suitable for rehoming to a one-on-one situation, but might be better cared for in a more of a community environment. So lots of different care options. Lots of ways that you can think about this. You just have to go through all of the different options. I would recommend to you a book that I've written called All My Children Wear Fur Coats, How to Leave a Legacy for Your Pet, that talks about all of the different variables and also touches on the planned giving techniques that Bill talked to us about. I would also invite you to listen to my weekly podcast, All My Children Wear Fur Coats, where every week we talk to an animal expert in animal welfare or animal health. And I would invite you to visit animalcaretrustusa.org, also found at actforpets.org, for more information on pet trusts and pet trustee services. And you can also find us for questions on Facebook, LinkedIn, Twitter, Instagram. We appreciate answering questions for you about how to plan for your animal companions. That's really my true passion in life, and I would invite you to reach out to me if you have any questions at all. Thank you so much to PETA and the team at PETA for all they do and for inviting me to share this very important information with you today.
Thank you so much, Peggy. Making sure we have our plans in place and current is crucial, and you have given us the essentials we all need. What Peggy, Josh, and Bill have been speaking to us about today has to do with mapping out our vision, how we can take action today to shape our legacy. A final element to consider is how our philanthropy can be a transformative component of the legacy we leave. As Ingrid said earlier, we cannot emphasize strongly enough how grateful we are for the critical financial support all of you provide to PETA through your donations. Making sure your support transcends you by establishing a gift through your estate, what we call a legacy gift, can be an equally powerful force for animals. And so before we move on to your questions, Daniela and I want to take a few minutes to briefly describe several of the many approaches to remember animals far into the future.
Thank you, Sepide. Legacy gifts represents 25 to 33% of PETA's income each year. The majority of these are gifts through a will or trust and gifts by beneficiary designation. These are gifts that cost you nothing today. You keep control of them and continue to benefit from your assets during your lifetime. They're also fully revocable. So if your circumstances change, you can alter or cancel them at any time. As Peggy mentioned, the fundamental piece of any estate plan is the will or trust. Including a legacy gift for animals through a bequest to PETA generally only requires adding some basic language to your document. Over the past couple of years, we have seen an increased number of gifts coming from members who made PETA one of the ultimate beneficiaries of their retirement plan, commercial annuity, financial account, or life insurance policy. As Bill discussed, retirement plans continue to be one of the best assets with which to support a charity like PETA. This is because the funds in your IRA have not been taxed. If you name an individual as IRA beneficiary, then that person will be taxed, significantly reducing the amount they receive. However, due to PETA's status as a charity, it does not pay taxes. So naming PETA as your IRA beneficiary means the animals will receive the entire amount. One approach PETA members have found beneficial is to leave less taxed assets to loved ones and make a legacy gift of retirement plan funds to PETA. It is a straightforward process to benefit animals with beneficiary designation forms and gifts. All you need to do is request your beneficiary designation form from your financial institution or retirement plan or insurance provider, then fill in PETA's basic information, its full name, its address, and its federal tax identification number.
Now, what if there was a way you could make a significant contribution to PETA that would not only leave a legacy for animals, but provide you with income for life? Well, there is, and it is called a charitable gift annuity. If you're 50 or older, along with a fixed income, a portion of which you receive tax-free, a gift annuity offers a significant tax deduction on the principal. What remains when the annuity ends is then available for PETA to use to further its mission to help animals. Gift annuities can be created to benefit one or two people. And to give you a sense of how they work, the member in this example is age 72. In exchange for her contribution of $10,000 US, she will receive a 4.9% gift annuity that will pay her $490 each year for life. It will also offer her an immediate tax deduction of $4,256, and she will leave a gift of its remainder to PETA. If you'd like to see whether a gift annuity might help meet your goals, we'd be happy to provide you with a personal illustration.
Earlier, Bill outlines the benefits of making gifts that have an immediate impact on PETA's work, specifically donating stock, and for those who are eligible, making a qualified charitable distribution or QCD from retirement assets. If you're interested in supporting PETA with a gift of stock or with a qualified charitable distribution, we are excited to announce that we now have online tools that can help simplify the process for you. By visiting us at PETA.org/QCD and PETA.org/stock, you will be able to submit electronic instructions to the company that holds your stock or retirement plan. The process is free of charge and will only take minutes. And for those of you who have a donor advised fund and want to consider making distributions from that to PETA, we have a similar tool at PETA.org/DAF.
To add a quick note, these assets that Daniela was just talking about can also be very versatile in helping you achieve your immediate and long-term philanthropic goals. For example, many PETA members not only make qualified charitable distributions or QCDs from their retirement plans, but have also made PETA a beneficiary of those plans, ensuring they're helping animals now and into the future. In addition to the giving strategies that we discussed today, there are further more complex gifting options that we didn't have time to discuss. Depending on your individual circumstances, they may offer you solutions suitable for your financial situation and goals to leave a footprint of compassion. Please do feel free to contact us if you'd like to learn more.
Well, we've covered a lot of ground, but we do still have time for a few questions. So let's start with this excellent one. Question from Miguel in Fort Collins, who asks, how much money should I leave for the care of my animals? Peggy, can you please speak to that?
Absolutely. And that's a great question and one that comes up frequently. And there's a lot of components to this, actually, not the least of which is what type of animals do you have? How many do you have? What are their ages? What is their health condition? And then how do you care for them? What are your care requirements? So you know what you spend on your animals today. And I always recommend that you think about, what do you spend now? Multiply that by a really long life expectancy, and then add a little bit more, because it's always more important to leave a little bit more than not leaving enough. And also, it's going to depend on how you want your animal to be cared for. Is it going to stay in your own home? Is it going to be rehomed? Or is it going to go to a sanctuary? So all of those factors are going to play in. So there's not an easy one-size-fits-all answer to this, but it is a mathematical calculation. And always better to leave too much than not enough, because you can always name a charity as the remainder beneficiary of your pet trust.
Great. Thank you so much, Peggy. And we have time for one more question. Let's see. This is from Cindy in Cleveland. Do ethical or cruelty-free investments outperform traditional investments? Also, great question. Let's see. Josh, can you speak to that one, please?
Yeah, absolutely. It's a question that obviously I get a lot, having kind of evolved with the ESG, space over, last decade or two. So, again, you take the genesis of the movement, and, initially it was called ethical investment because you only did it for ethical purposes. But when you calculate the risk reduction mechanisms that being attuned to, for example, environmental policy, being attuned to the social implications, adhering to certain governance and diversity issues. Again, just not just opinion-based, but there's been a lot of research out there. And if you want to follow with me, I can certainly forward some of this research. But that research does show that you reduce the risk, which in turn increases the long-term return. And so that's when I was making that comment of, you can have your vegan cake and eat it too, because if you can go ahead and do ESG or cruelty-free investing and still make above market returns, why not? And in fact, we're seeing a lot of institutional investors mandate ESG investing as part of their framework. So in other words, I see a time in the next, maybe decade where you don't even hear about ESG investing. It's just investing. It's part of the general regulatory framework to undergo ESG screening to make sure that all of those factors are being taken into consideration. But from your perspective, rest assured that you can move forward, be ethical with your investments, and also get market rate or above market rate returns.
Thank you, Josh. We have come to the end of our time for this webinar today. We were not able to get to all of your questions, but we will be in touch with those of you whose questions were not answered. I also want to mention that not only do we have a number of resources that you can download at PETA.org/resources, but that we are here to be a resource to you as well. Thank you again to our wonderful guests, Peggy, Josh, and Bill, and many, many thanks to all of you for attending and for the critical support you provide PETA every day. Goodbye for now, and we hope to see you on a PETA Zoom event in the future.